Obviously, the one new piece of news since back then was the departure of the CFO, and some interpreting that as perhaps some sort of acceleration or sign that the strategic shift is happening. What is your sense right now, as someone whose longstanding bull case is fundamentals based? What is your sense right now about what is happening on the sort of the strategic pivot?
Well, Joe, thanks for having me back on. I'd say there's more than just the CFO departing. We got some hires that happened between last time you all had me on in late January and now. We had a new chief technology officer added. We had a new SVP of customer care, a new VP of fulfillment. So we had those three ads. I think two former Amazon execs, one former Chewy exec. The Chewification of GameStop continues. So we've got the CFO vacancy right now. We'll see who takes the reins there. But I think that they're making progress in the direction that Ryan laid out.
So, I mean, articulate for us sort of what that progress is or at least what the general vision is for GameStop. Is this going to be that brick and mortar retailer that we kind of knew it to be years ago, where you walked in and bought a game? Or is this more about some of the online offerings and the ability to buy things in-game? Is that going to be the expansion here?
I mean, I think the supplier relationships GameStop has are the place that I believe they can get some better leverage points on outside of the brick and mortar channel. So given that they have the purchasing through both the OEs as well as the publishers, are there ways in which they can create GameStop exclusive digital content, perhaps subscription based, to get a better multiple on revenues associated with that sort of a model? We haven't seen that come from the company yet. However, I think those of us that are monitoring Mr. Cohen very closely see he continues to follow a very select group of companies. We saw him follow, I think, Electronic Arts, Activision Blizzard, et cetera. So one would presume, if we're trying to read those tea leaves, like we are reading his frog and ice cream tweets, that he's got something going on behind the scenes. So I think, though, one thing I do still want to highlight that I think people keep missing is that it is not a mall-based retailer domestically. I was looking up in the transcripts from the fourth quarter earnings call they had, and they talked in 2018, excuse me. And in the transcript, it specifically says outside the US, 90% of our stores are mall-based, but inside the US, it's reversed, and 90% of the stores are strip mall-based. So I think the retail implications are significantly different when we think about a strip mall-based retailer, and the foot traffic implications, the lease renewals, et cetera. So that's something I think is important to dispel. People keep saying mall-based retailer, and it's not quite that.
Rod, it's interesting. We're trading currently at a price of 108. On GameStop, and it's way off the heady heights of in excess of 400 that it once hit. But last time you were on, we asked you as to whether they should make the most of this moment with an elevated share price, where they should sell stock and reinvest. There were some calendar technicalities as to why they didn't when we were at those heady heights. But would you like to still see them do that now?
So, Caroline, your point is good, and I know that Reuters had that exclusive that I think helped us all understand the SEC-related implications of why they didn't take the action that we perhaps hoped they would. But, you know, look, the price, I think Joe and I talked about it in the Odd Lots pod, Joe and Tracy and I, and there's not a compelling need for them to raise capital just to raise capital because the market observers think the price is elevated. They're going to be generating cash flow this quarter, personally thinking that they're going to be a bit over $1 EPS-wise. It's not a function of a need to raise the capital until we know what the roadmap is. So I wouldn't want them to dilute shareholders until we understand where the prospective dilution is going to be going towards, whether they're going to be investing in more fulfillment upgrades or investing in some of their digital properties. You know, we still have yet to see that, and I don't know that we're going to see anything until the fourth quarter earnings call in about a month's time. So, you know, I think we're in the same situation we were in late January, where given the material non-public information the company's privy to, they're not in a position to raise capital, and they don't need to, although it would have been nice to issue at $500 a share.
Rod, of course, you know, having been in the stock and part of the story for a long time, you were part of the crew that used to watch those live streams from the Roaring Kitty on YouTube, DFV on Reddit, and of course now we all know his name is Keith Gill, who everybody finally got a chance to meet properly when he testified in front of Congress last week. What was that like for you, watching your old friend there, and how do you think he sort of represented the GameStop bulls, the believers?
Yeah, Keith, super articulate guy, smart guy. He's not a cat. He does like the stock. We know those things about him, and enjoyed what he had to say. You know, to be quite frank, I think he was the most human on the entire panel.
Definitely.
If you watched the entirety of the hearings, and he came off as somebody knowledgeable but also relatable, unlike maybe some of the more robotic type responses. So I think he did all of the fellow GameStop investment community a really great job.
Yeah.
I know it's funny. I think it was the day after, posted his update on Reddit that he added 50,000 shares at, I think you get back into the math, was like 38.70-ish cost basis, so just above the bottom. So, you know, in terms of tactical trader, looks like Keith did a pretty good job. Now, I think he likes the stock though, and I don't think he's selling right now.